Martin, thank you very much. At this point, I would like to invite Eric back to the stage, and he's going to conduct a fireside chat with Peter Hancock. Peter, of course, is a frequent guest at MIT in Bob's classes, and he is here to talk about his perspectives on Bob's influence on the practice of finance.
Okay, so as Leonid said, this session will focus on Bob's influence and impact on the practice of finance. I'll be talking with Peter Hancock. Peter has a long, illustrious career in finance, dating back to the 80s, starting with JPM and ending as CEO of AIG. Among a number of your roles, 20 years at JP Morgan, you ran the derivative business, which was highly successful and really viewed as the innovation leader. What did you know about derivatives before you were given the job?
Close to zero. Not quite close, not completely zero. I actually benefited from a 1-week offsite with Marty, where he sort of used elementary binomial pricing model to sort of illustrate that optionality made sense. But the math of Ito calculus was way beyond me, and so I had a very rudimentary understanding. I was very fortunate to be at an institution that had spent 100 years building trust with its clients, with some interesting problems to solve, but I certainly would have benefited from Bob's course before being let loose on large amounts of capital. So it's a good question.
What were some of the challenges you faced sort of starting up this business?
Well, so to give you a sense of the scale, so this was a business, and let's start with the swap business, which is the interest rate swap business in the early 80s. We could keep all of the swap positions on one piece of A4. And by the time I left, the amount of notional of swaps, and this is when the company was sold to Chase, was roughly $20 trillion, and today it's $60 trillion. So there were challenges of how to manage the growth with the technology we had at the time, and the swaps were basically matched, so that was fairly simple if you had customers with needs that were offsetting. And so having a great customer base made the company a trusted counterparty, had a AAA rating that made it relatively easy compared to some of the other participants. But as we started to get into options, I think that my biggest challenge was something I find anytime I shop at IKEA. I don't know how many of you have tried to assemble IKEA furniture without reading the instructions. Well, we saw the sort of 6 assumptions behind Bob's theories. I wish I'd read the 6 assumptions before I started to think that I had a hedged book. When we looked at the interest rate cap market, where we had all of the Greeks at 0, and so we went to bed thinking that we were going to wake up on October the 19th in 1987 fine, but with the 2-year Treasury yield,
it's all a blur for me.
dropping by 120 basis points over the weekend, we realized that strike mismatches matter. And so, so this ability to think about all of the ways in which theory translates into practice and to understand the assumptions was something which I wish I'd had a better grounding in. But frankly, fortunately, I had an organization that didn't assume ill intent and trusted that we would learn from these errors. And so as we started to do more complex things, I think we started to recruit from places like MIT. So we had more skills and a real research department, one of whom is going to be speaking tonight, Doug DeShiel, who is phenomenally successful in keeping me out of trouble. But at the end of the day, listening to customers and meeting their needs, I think was the sort of the true north, because there are many things that you could do with these instruments as a speculator, which we absolutely did not do. And we sort of tried to stick to our knitting of trying to intermediate between a huge and diverse client base that were faced with offsetting risks and trying to figure out how to bridge that in pragmatic ways.
One thing was a number of these investment banks traded these derivatives in silos. You know, so the interest rate swaps were traded differently than the swap options, were the cross-currency swaps. At JP Morgan, you had a different philosophy. It was a global business. How did you view that as a comparative advantage?
Well, there was two aspects of that. There was the sort of asset class silos, but there's also this sort of silos between the so-called quants and traders and those who actually had trusting relationships with clients. And I felt that either of those divisions were counterproductive, and you needed to sort of build internal trust in this organization of about 20,000 employees around the world. But I think the most interesting challenge was on the foreign exchange options business, which I inherited in 1990, where that had been 3 silos, one in London, one in New York, and one in Singapore. And the New York options desk, which had been going on since about 1975, so that's a fair amount of time to build up a sort of business practice, set their alarms for 3 a.m. every night to rebalance their delta. And so I suggested that perhaps they should trust their colleagues in Singapore and just unify the book into a single book. And they said it won't work, it won't work. And so they did it, and amazingly, the next month they said this is the best thing that ever happened. We had a full night's sleep. And so these are sort of pretty simple things. But you know, these little case studies of sort of trusting people who you've never met on the other side of the world who work for the same organization. And you know, just simple things like you take them off on an offsite and get them to realize that they know just as much as you do and are going to make mistakes, and you're going to have to forgive them of errors. And you're not going to make better judgments at 3 a.m. Than they're going to do sitting in the trading floor. So those sorts of things. But I think transparency was the biggest thing between people who had the trust of clients and the people who had the domain expertise, and breaking down those barriers. And I was very fortunate to have a mentor in Dennis Weatherstone, who had grown up running foreign exchange, treasurer, and then became the CEO of JP Morgan, who saw the benefits of really explaining complexity in simple terms. And I think one of the things which I've always found amazing with Bob is his ability to take complexity and explain it to a liberal arts major. And so that, to me, was critical to build the trust, because these instruments give you unexpected results. And I think that it would have been easy to abandon this business early on when we sort of had setbacks, if there hadn't been a willingness to examine what went right and what went wrong and learn from it. And you know, one of the important things was to break down these silos. And they sort of work by geography, by specialization, by seniority. You're getting a board of directors comfortable that this is a business worth growing. So yeah, I think you know, one of the most exciting ways, and then the first time I spoke to Bob was in the aftermath of an interesting event, which was, you know, we had decided that if swap options work in dollars, maybe they'll work in Deutschmarks. So we started to build a Deutschmark swap option market, and by complete luck, not planned, serendipity, I suppose, the Berlin Wall fell down.
I hope you were long volatility.
Well, we didn't have a very big volatility position on, but we had the mechanism to go long, and that was the key, which was that the need was the federal government in Germany needed to borrow an awful lot of money in a hurry. And so we said, well, I think we've got a way to do that for you. Why don't you issue privately issued Schuldschein, non-tradable debt, 10 years in duration, puttable after year 2, and we'll strip the put. Because Bund volatility, the volatility of 10-year non-callable bonds, had gone from 5% where it had been for the previous 30 years to 25% out of uncertainty as to what it would cost to rebuild Eastern Germany. And so in the space of about 6 months, we were able to buy almost 70 billion Deutschmarks of these 10-year puttable bonds and sell the volatility to various investors in the US mainly. And a completely unintended consequence of that series of transactions was that all of these investors that had bought the volatility from us were dynamically hedging their position and crushed the volatility in the bond market because they were buying when people were selling and selling when people were buying. So we made the whole market long gamma while the German government was short gamma, but that for them was just outsourcing intervention in the money market. So it's sort of an interesting case study of very positive externalities, unintended from a process of using these instruments to solve a very real need, which is an urgent need to A, finance, and B, calm the markets in terms of the uncertainty of the scale of the financing challenge for reconstruction. None of this could have happened, however, if the company, JP Morgan, hadn't spent 100 years building the trust to deal at the sovereign level at scale. This is a company that bailed out the French government in the Franco-Prussian War and was given the Place Vendôme as a present by the French government. So, on the shoulder of giants was this ability to innovate in a way because that trust had been built up by people who worked there many years before I was there. And so I was super fortunate, I think, to have been there in a 20-year period where these innovations could be put in practice at scale with a lot of interesting counterparties.
So suppose you had been Bob's student. What would you have done differently?
I think that I was very myopic until I really got to know Bob in terms of just trying not to get my head handed to me. And I think that Bob's ability to step back and look at the world, literally the whole world, and say, okay, where are risks currently distributed and where should they be distributed, is a sort of, makes him the Wayne Gretzky of finance. He knows where the puck is going. Where is the risk going to be? And I was sort of always in a reactive mode of how do I dodge the puck from hitting me in the head, So I think that I think he would have given me a much better ability to anticipate some of where the institutional rigidities were causing risks to be trapped in the system at a macro level globally, but also within industry. So I think that that ability to zoom out and then zoom in was something that I learned from Bob way too late in my career.
All right, let's fast forward to 2010. It's immediately after the financial crisis. You decide to go to AIG, and you're going to oversee the firm's risk exposure. So I guess the question everyone immediately comes to mind is, why would you ever take that job?
Well, I can give you the honest answer. It was a shorter commute than Cleveland, where I was commuting to. But no, I was asked by the Fed and the Treasury, and ultimately by others to help Bob Benmosche, who had been appointed as CEO 6 months before, in turning around the company. And I was very skeptical, to be honest. But as I met Bob and I realized the opportunity to apply everything I'd learned at JP Morgan and working with Bob for 7 years to solve a unique problem, I thought this was, even if it was a one-year gig, it was worth trying. And I ended up being there for 7 years. And that first year, though, was a very interesting application of almost everything I'd learned up to that point at a scale I never imagined.
Give us a feel for what the risk exposure was when you came on board.
So the total on-balance sheet assets and liabilities was $800 billion. But the off-balance sheet assets and liabilities in derivatives, which were all asset classes, and some of them very long dated and complex, was almost $2 trillion. But interestingly enough, the insurance industry does not actually add up exposure, unlike the banking industry. They keep score by the amount of premium that's paid. So I literally spent years trying to actually get data on the aggregate amount of insurance policy limit, and that's a very big number I won't disclose in a setting that's filmed because it's not public, but it's a big number. So it's a very big balance sheet. It's by far the biggest insurance company in the world. And the prior management, just after the crisis, was in the process of liquidating the company. And the government, as probably everybody knows, has injected a very substantial rescue package in many different forms to the tune of about $182 billion. So the US taxpayer was on the hook, either as direct investment or undrawn backstop facilities to the tune of $182 billion. So the challenge was, how do you get the taxpayers' money back, let alone try and create a going concern. And Bob Ben-Moshe, my predecessor as CEO, took the job as CEO only on the condition that he could salvage a going concern, because he believed that his predecessor, Ed Liddy, in liquidating the company was just going to destroy a huge amount of value and lose the taxpayer a lot of money. And the Congressional Budget Office estimated that the loss to the taxpayer would be roughly $40 billion.
That's if you liquidated everything.
Correct. Well, no, actually, that was even once the markets had recovered. So that estimate from the CBO was at the end of 2009. So in the middle of 2008, just after the rescue, it was a much higher number than that. So there was a lot at stake in terms of what the liquidation would be.
And how did you think about the business's value as a going concern?
Well, there were some businesses that really should never have been there. They were, it was, on the face of it, an insurance company. It was a financial conglomerate, though, with a AAA rating that had entered into almost every area of finance. It owned banks. It owned one of the largest portfolio of commercial airliners, 1,000 airlines. And when you have a AAA, you can finance illiquid long-term assets with very short-term money. So if you're focused on the mean, you got tremendous EPS. If you're looking at the tails of the distribution and model the chance that liquidity dries up without access to the discount window, it's not a great risk-adjusted return. So I think that the value of certain businesses was negative if you didn't have access to liquidity. So those businesses didn't belong in an insurance context. But some of the core insurance businesses were very valuable. And so the initial strategy was to sell the businesses that were vulnerable to liquidity shocks. And there was a contingent liquidity risk of about $25 billion that would happen if the rating of the company went down one notch. So getting those businesses off the books into the hands of others was an important way to create resilience for the company. But I think one of the most interesting challenges at the time was to persuade the stakeholders.
Which is the government.
Well, that's what I thought. I was really I'd spent most of my career avoiding Washington, D.C. So I had this sort of simple sort of Econ 101 view of sort of the household sector, the corporate sector, and the government. And then when I got to AIG, I realized that the New York Fed was not the government, but a separate entity with separate governance. They had set up separate trusts with different governance to oversee special purpose vehicles, which created quasi-discount window facilities for non-recourse loans to various assets, all of which happened before TARP legislation happened. Then the US Treasury came in after TARP legislation with various forms of assistance. And so we had multiple government stakeholders, all of whom had a piece of that $182 billion. We had public shareholders, we had debt holders, and obviously employees, customers, many, many stakeholders. And none of them could agree on how to restructure this company. And they all effectively had a veto right over any restructuring plan. So there was a stalemate. And
So you've got all these valuable assets, but you've got the stakeholders wanting their money back to get out. How did you talk them into giving you more time?
well, time was ticking during 2010, a lot of impatience. And so I thought I'd go back to first principles, and I did a risk balance sheet and contingent claims analysis until the math got too difficult, at which point I called Andrew Lowe and said, can Andy help? And so what we did is we modeled the balance sheet liabilities of the company using an implied probability distribution of the enterprise value at various snapshots from the crisis every quarter. So we'd look at implied volatility of options, we'd look at the price of subordinated debt, senior debt, the equity, and what we found was really interesting. Compared to all the companies that I'd looked at in the past this way, which typically had a log normal distribution of the enterprise value, so you could sort of look at the risk of default, AIG had a bimodal distribution. It's a double hump. And we said, well, why is that? And we realized that there were sort of two regimes implied by market expectations. One was a going concern, and the other one was a liquidation value. And we looked at various points in time from the crisis until the summer of 2010 at the relative size of these humps. And as you can imagine, as people felt that the place would be rescued, the bottom hump shrank and the top hump grew. But then when it looked like the rescue wasn't going to happen, it reversed itself. So there's some systemic effects and there's some idiosyncratic events. But the idea came, and we used the jump diffusion model to capture the second hump. And we estimated that if you could basically truncate the bottom hump and make it a more log normal distribution, there was what we coined the term as a peace dividend of 14 billion to distribute among all the stakeholders. So if they'd all compromise enough in their claims to allow for an exit from this stalemate among all these people, there was 14 billion to share among them all. And so that's what the model predicted. And in September of 2010, when we announced the restructuring, which paid off the New York Fed and converted the various assistance from the US Treasury into common equity, 92% ownership of the company, the enterprise value went up by exactly 14 billion. It's complete coincidence, but it was one of those exciting things where you see theory and practice converge. And of course, the happy news is that we sold the government's equity over the course of 2011 and 12. And so by November of 2012, the government got its 182 billion back, plus another 23 billion. So huge swing in value for the taxpayer, over 60 billion value. And I'm not saying it's all because of Bob's contingent claims theory, but I will give huge credit to that as a way to unlock what was a huge deadlock. And if you compare it with Royal Bank of Scotland, which I think is still partially owned by the UK government, this was a way to, I think, demonstrate this is not a zero-sum game among all of these stakeholders, but there was a real win-win opportunity. So it was, to me, the most satisfying moment of my professional career was to take theory and apply it in a very unusual circumstance, and it was a lot of fun.
Well, my final question to you is, if you had been one of Bob's students, is there anything you would have done differently at
AIG? Well, I probably would have spent more time trying to do selfies and retirement products. But I think that, to be honest, the time horizon that I was forced to deal with meant that some of the long-term investments in what it takes to come up with a retirement solution was on the back burner. And I think that to reframe the question, if I was still at AIG, that's what I'd be doing now, because I think the company now has put its risk challenges behind it. The last act I did before I was ousted by my activist investor, Carl Icahn, was I think the largest reinsurance transaction ever done with Berkshire Hathaway to truncate the tail risk of decades of casualty business that was a very difficult tail risk to manage, and that was the only hedge available. And I think left behind a clean balance sheet to start focusing on innovation and solving the retirement problem. Because I think as a counterparty, they're among the best suited to solving this problem and being a buyer of selfies and then an issuer of annuities. So perhaps I would have been doing more of that.
Great. Well, let's open it up to questions. Mr. Zvi. Oh, wait, Zvi.
How did Bob first get to J.P. Morgan as a consultant?
Ooh.
That's a question for Bob.
Oh, you don't know?
Well, I think it's Roberto. I think Roberto floated the idea, and I jumped all over it. I said immediately. So I was, at the time, CFO of J.P. Morgan, and Roberto sat across the corridor from me. And so I said, if we can persuade Bob to come. And the persuasion was that we would start working on a retirement system using J.P. Morgan's capabilities. Now, little did I know that a year later, Chase would buy the place. So best laid plans. But
I should note, by the way, that at Bob's suggestion, you hired me to try and come up with a solution for defined contribution, for the J.P. Morgan
that's right.
retirement plan.
I got 2 for 1.
You're still working on that solution.
I'm still working.
That's right.
Thank you, Mr. Hancock, for that interesting talk. So as you said, a part of Professor Merton's genius is that he's able to zoom out and identify these global macro risks. So just out of curiosity, given that property and casualty insurance is such a large part of AIG's business, and I feel obligated as a Gen Zer / millennial to ask, how is AIG, or what were you doing to kind of mitigate the risk of the advent of climate change and the massive potential future claim volumes coming in?
So climate change has probably the greatest impact on physical infrastructure. So the property, out of the property and casualty side, is probably where the biggest concerns are. The property insurance market reprices annually. And obviously climate change, even though it manifests itself in shocks, is a gradual trend in terms of the mean expectation. So as we looked at it, we felt that the best place we could help was in mitigation. So in the case of Superstorm Sandy, AIG paid $2.5 billion in claims to thousands and thousands of businesses and hundreds of thousands of individuals, but learned a lot in settling those claims about what could have been done to have mitigated those claims. And that was $25 billion out of economic losses of roughly $50 billion, half of which was picked up by FEMA. So I think that the expertise that comes from events like that, the Thai floods, the floods in Australia, was where we could help cities better prepare for more and more frequent flooding events. So we felt that sort of narrower focus, rather than broader policy, was where we could help most, and now play to our comparative advantage as a company. Personally, more recently, I've been interested in an idea, and I can't resist the opportunity to try it out in this audience, because it's one of the few audiences that would shoot holes in it and maybe improve it, is the idea that occurred to me, frankly, when TIPS were being launched, which is to create 30-year bonds that are indexed to carbon parts per million, and 30-year bonds linked to seawater temperatures. and to use those as a way to infer long-term market expectations on those two, to infer tail risk through the options on those two instruments, and then correlation between the two. And I presented the idea to the Norges Bank, to the Bank of England in the last month. Whether it ever takes off or not, and whether we can persuade issuers to issue it, who knows? But you know, that's not something I could have done when I was at AIG. But it's something which I feel, you know, if we can apply financial engineering to help inform a policy debate, which I think has a need for at least some reference point as to whether we're doing enough fast enough, and whether the things we are doing are having any impact on expectations. I think it's a way to go. So if anybody's interested, I'll send them the paper. It's only a one-pager. I've got a granddaughter as of 2 months ago, and I'm caring about whether she's going to have a future as well.
Well, if there are no more questions, I believe it's cocktail time.